I adore making investments in dividend growth companies, which essentially entails holding onto stocks that spontaneously generate income. They assured me dividends would be simple, but I'm not sure if it will be really that simple. Currently, I kind of talk about my love for investing in dividend stocks and creating passive income on my YouTube channel. But in today's video, I kind of wanted to show you the other side of the coin and explain why dividends are not the greatest investment plan and why dividends don't really matter at all. Therefore, if that dull, dry video topic concept appeals to you, this video is for you. Let's start. First, by giving you everything, I'm going to make you fall in love with dividends. If you're unsure of what they are, I'll explain why I appreciate dividend investing in a straightforward manner. After which, I'll make you despise dividends by presenting the entire opposing case. After which, I'll rekindle your love. So in essence, this video is absolutely pointless, almost like fusing an agnostic with a missionary. Starting with the 4 main reasons why I fell in love with dividend investing and why you might want to give it some thought. Let's move on to the pros and cons. According to the Hartford research, dividends that were reinvested comprised a sizable amount of the stock market's revenue. If we go back to 1970, which is almost 50 years of data, it reveals that 78% of the entire total return of the stock market was made up of dividends that people got and then reinvested back into the market. If we go back even further, we can look at data from 1930 through 2019, which gives us almost a century's worth of information, and it reveals that over the last 200 years, reinvested dividends have accounted for about 42% of how the stock market made its money, which is significantly less, but still a sizable portion. Although the stock market has historically generated returns of 8 to 9%, this does not necessarily imply that investors have made that much money. In fact, according to analysis from the BlackRock investment firm, the average return on investments over the past 20 years has only been 2.1%, just above inflation. People panic and sell their stocks when the stock market declines, which is the source of that. Subsequently, whenever the stock market starts to rise again, they buy again, but this time they've missed out on all the expansion. However, being a dividend investor provides you the tenacity to truly achieve those 9% stock market returns that are advertised. That is due to the fact that you are already making money and sort of collecting it in the form of interest, so you don't need to sell your stocks in order to realize and make that profit. As a result, you are less likely to panic, sell, and end up as a statistic as a result of your emotions. Imagine your name is Michael, and you owned $2 million worth of Tesla stock. You recognize that filming 6 YouTube videos every day is not sustainable, and that you should slow down and take a break when you are 40. Since Michael was a long-term investor, he didn't sell his shares of Tesla when they reached a value of $6 million. However, something else happened, such as the stock market crash, the emergence of a new competitor, or the discovery of fusion power. Whatever the case, just as he was about to retire and satisfy his imaginary wife Lauren, the price of Tesla shares plummeted all the way back to $2 million or even lower. He recognized that he had just lost 10 years worth of progress, which is almost as emotionally debilitating as my anxiety. Many people experienced this back in 2008, when their 401k and IRA accounts lost value and they lost access to them, delaying their retirement in some cases indefinitely. The conclusion of the narrative is that Michael will be fine because he still has millions of dollars. We, on the other hand, should be concerned. You may be familiar with the cliche, you can't put a price on peace of mind. And since my immigrant family didn't teach me how to take risks, I prefer dividend investing because it places a strong emphasis on cash flow. So for instance, even if Coca-Cola had a really poor quarterly financial report, I wouldn't really care because I would still be receiving dividends as long as Coca-Cola kept doing what it was doing. I will still be paid as long as people continue to consume soda, which they will, and as long as people continue to be dependent on sugar, regardless of what is happening in the globe. Even as stock prices fall during the 2020 pandemic, dividend yields rise. So let's imagine Coca-Cola had a $100 market value and was paying a 4% dividend yield. Therefore, Coca-Cola will return to us $4 for every $100 invested. But there's something nice about those $4, because even if Coca-Cola's price is dropped in half to $50 per share, the $4 will still be the same. This is because as the stock price declines, the dividend yield rises to make up the difference. That's quite fantastic since I could use those $4 to pay my expenses or to invest in Coca-Cola or any other firm I choose. Let me know in the comments if you have any other questions about investing. Let's return to the video. Let's now discuss the drawbacks of dividends and why you might not wish to invest in them. The fact that dividends are not guaranteed stands. Dozens of businesses have reduced their payouts only in 2020. One of the businesses I controlled, Delta, also reduced its dividend. Disney decreased its semi-annual dividend, which occurred in July. They paid out twice a year, and they cut that one. This happened to a corporation that I thought would never happen to them in a million years. As a result, if you're a retiree who relies on dividend income to pay your expenses but doesn't get paid that month because we aren't owed dividends, you won't be able to do so. There is no legal agreement between us and the firms we invest in, and they are always free to significantly reduce or, in the worst case scenario, completely eliminate the dividend. Typically, the stock price drops even further when it occurs. Stock growth or capital appreciation is my answer to this. When the financial crisis of 2008 hit and stock prices dropped, the dividend income really decreased by approximately half. Due to the fact that we can reinvest our dividend income into additional dividend stocks as it is received, dividend income is really much more reliable and predictable than capital growth, especially in a stagnant market. It fluctuates up and down, but the final effect is the same, since we're earning money and investing it back. If you're concerned about losing dividends, put your money in a high-quality dividend exchange traded fund or ETF that swaps out the stocks of firms that automatically lower their payouts. Dividend payments are a company's way of saying, we have so much money, we have run out of ideas on how to grow our company, so have some money back, which means that stock won't likely increase in value as quickly as, say, Tesla. As a result, dividends limit the overall growth and returns of a company. In fact, if a company isn't constantly innovating and producing new items like Tesla, it might be in a danger of going out of business. In fact, if you compare VIG, which is Vanguard's counterpart of the dividend growth golden standard, to VTI, the gold standard of index investing, you can see that VTI has outperformed VIG over the past 10 years. Even while that hasn't always been the case, a number of studies have found that dividends have contributed significantly to the overall returns of the stock market. Corporations that stop growing don't necessarily stop making a lot of money. They just won't grow at double-digit rates like some of the smaller businesses. In exchange for making a lot of money, however, these companies reward us with a share of their profits and gradually raise their dividends. Since understanding some of those studies will put you and me to sleep, I will provide links to some of them below, but the information is available if you want to look at it. You will pay more in taxes, and dividends are not free. Consider the fact that dividends come from someplace. Therefore, if the company pays us a dividend, the stock price will fall by the same amount as the dividend that was paid. As a result, all you're doing is shifting money from one place to another, sort of like moving money from your savings account into your checking account. You could technically consider that as income, but all you did was move money from one place to another, and you got taxed while you made that transfer, which is completely pointless in contrast to something like growth stocks, where you don't get hit with those taxes because there isn't a forced withdrawal. I will admit that this is one of the biggest reasons against dividend investing, because you pay less in taxes. Technically, it is a forced withdrawal. However, if you're concerned that the dividend stock price would decline by the same amount as the dividend, consider this. Just keep in mind that it doesn't simply go to zero. That is not how it operates. If you're concerned about paying taxes, invest in a Roth IRA account because the money you receive there is not taxed at all. The stock price eventually returns in just a few weeks, and sometimes nothing happens to the price or it even increases. However, if you invest in a taxable brokerage account like I do, you will pay a slight premium in taxes to receive that income. However, to me, this is worth it to have the option of retiring early and having that passive income. However, keep in mind that since you've slowed down, you'll likely generate less money in retirement if you're retired. And in that scenario, if you're filing alone, you can make up to $375 without paying any taxes. However, if you're filing jointly, you can make up to $78,750 in qualifying dividend income combined without paying any taxes. Again, what kind of income enables you to earn approximately $80,000 per year while paying no taxes? Correct? The one that all very wealthy individuals own. It makes sense that doing so would reduce diversification. Consider the fact that when we invest in dividend stocks, we're only putting our money where there are large, well-established companies, and we are ignoring the mid and small-cap companies that have the potential to become the next Apple, Tesla, Google, or Amazon, because they won't pay us dividends while they are still in the early stages of growth, and we wait to invest in them until they are large. Because we missed out on all that growth, diversification is reduced. Although this is technically correct, there is no restriction prohibiting dividend investors from purchasing small-cap companies. They are free to do both if they so choose. You can't put a value on peace of mind, and successful investing is just as much an emotional game as it is a numbers game. As I said at the beginning of the video, dividend investing only offers you emotional benefits and offers you no real advantages over just regular index and growth investing other than just making you sleep well at night. I can stay in the market much longer and have a better retirement as a dividend investor because I can concentrate on cash flow rather than worrying about what my stock price is doing on a day-to-day basis. This is because I don't have to worry about when the market is the best to sell my stocks and exit the market. That's a very, very strong statement, and it amazes me that people debate these issues online given that these are first world issues. You must be a money nerd if you're viewing this video on your phone and have made it this far, because you're likely to succeed in business better than 99% of people worldwide. Just keep in mind that there are numerous ways to achieve the same goal, which is essentially to finish up with more money than we started with, as you're traveling down that path. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.